portfolio has survived the ultimate stress test for any economic sensitive sectors like airports. So bear that in mind when you look at the returns. The fund invests across a range of mid-market Australian infrastructure assets ranging from regional airports to gas pipelines to wind farms, right through to infrastructure assets like the Gold Coast Light Rail. So I'm delighted to introduce Vicki Rigg from the Palisade team to take you through why Australian mid-market unlisted infrastructure should be in your portfolio through the cycle. So please welcome Vicki.
Thank you. I always enjoy speaking last, except when Mark steals my thunder. His introduction was fantastic to give you a sense of the size of private markets, but also the size of infrastructure. Globally, it's estimated that we need to invest around $4 trillion a year in infrastructure. Now, a lot of that money will come from governments, yes, but there's a significant opportunity for private investors. And APRA's numbers are actually slightly larger than the numbers that Mark put up earlier. APRA estimates that about 8% of all its regulated funds are invested in infrastructure. Unfortunately, as an asset class, though, it's been really difficult for smaller investors to invest in the sector. It's obviously an unlisted asset class, and there aren't many products that are designed for smaller wholesale investors. We like to use 3 words to describe what we do as a business. We invest in tangible, real assets, and most importantly, we invest in assets that are essential. They're essential to our lives and they're essential to the economy, and it's the essential nature of infrastructure that means that we're generally investing in businesses that have a preferred market position. They have high barriers to entry, and importantly, that means they have more predictable cash flows. I'd love to say predictable, but compliance won't let me. And it's the lower risk nature of infrastructure that means that's why people invest in it. Institutional investors, the large superannuation funds, have been investing in the sector for over 3 decades. And it makes a significant part of their portfolios because it produces predictable cash yields, it produces moderate capital growth, it produces correlation with inflation, and most importantly, it's not correlated with other asset classes. Now, I know everybody likes the chart, and we don't use many charts, but I do like this one because it does show, for me, the role that infrastructure can play in your portfolios. Now, you probably can't read it from where you are, but the blue line shows the return that you would have made if you'd invested in our flagship diversified infrastructure fund 10 years ago. The grey and orange lines show the same return that you would have received by investing the same amount in equities in the case of the grey line, or in listed infrastructure in the case of the orange line. Now, I'm very proud of our returns, and Mark already mentioned that over the last 10 years, we've generated close to a 10% annual return for our investors, with over 5% of that being in the form of yield. But it's not really the returns that I want to focus on here. It's the low volatility, and it's the lack of correlation with other asset classes. Now, hopefully I've hooked you all on why you should put infrastructure in your portfolio. I should introduce Palisade. Mark actually undersold us. We've got a 16-year track record. We've been investing in this space for over 16 years, and we've always focused on mid-market infrastructure. We've got close to $5 billion of funds under management, and that's invested in 31 assets. But for me, the most important thing we've built over 16 years is the team of people. We've got over 60 people in the team investing in infrastructure. It's a high-touch area. It takes a lot of time and effort both to invest in the sector, but also, most importantly, to manage those investments once we've acquired them. We're investing for the long term. We run open-ended funds, and a number of the investments we currently hold in our portfolio we've held since inception. Now, you've already heard a bit today about why mid-market is so attractive in the case of private equity. It's not that different in the case of infrastructure. We've always invested in mid-market infrastructure. We really like the space because it's less competitive. And so in the supply-demand equation, you can get better returns investing in the mid-market. You can also negotiate bilaterally, which means that we get not only better returns, but better terms on the things that are important to us, and also better terms for the people who are selling, which is important to them. It's estimated by Preqin that last year about 80% of all infrastructure transactions were in the mid-market, but there's only a tiny proportion of managers who are actually playing in this space. The other thing that we love about mid-market is actually the size of the stakes that we can take in the investments we make. We love to buy 100% of a business. We'll buy as much as we can because it means that we can actually work alongside the management team. We can make sure that they're incentivized. We make sure that they're aligned to investor outcomes. And alignment is something that's really important to us, both within the businesses that we invest in and also within our team. We ensure that everybody who works in the business is aligned to investor outcomes. Finally, the other thing that mid-market allows us to do, it allows us to build a really diverse portfolio, and it allows us to bring together smaller investments and create enterprises. And those enterprises have greater value than the sum of the parts. And it gives us a stronger preferred market position. It gives us more ability to generate returns for investors. About a quarter of our portfolio in our diversified fund is invested in renewable energy. And this video shows you a little bit of what it takes to develop a wind farm. So we developed this wind farm in northwest Tasmania over a 3 to 4 year period. It just gives you a sense of the remote nature of where we were building. And to add to the complexity of it, we commenced construction just prior to COVID. So we not only had to get people to site, we had to get them through state lockdowns. This is what goes into building a single wind turbine. You can see it's much bigger under the ground than you perhaps anticipate. Each blade was 60 metres long, so to get them to site we had to close roads, remove telegraph poles. It's a huge logistical exercise. We had to work with the local communities to ensure that they were happy with what we're doing. And this project had a big impact on the local economy. We employed around 200 people during construction, and it supplies, now it's complete, electricity to around 40,000 homes. It's also the energy project that put Tasmania over its target of supplying 100% of its power from renewable sources. The site's so remote that we had to use helicopters to get the transmission line to site. It just gives you this gives you a sense of the scale and the complexity of the project. It's now managed by our team of technical experts that are based in Melbourne, a team of engineers and commercial analysts that are specialists in the renewable energy sector. And the best bit about the job is we get to go and visit these things. So that just gives you a sense of what we do. Now, I often get told that I don't make infrastructure sound exciting enough, and it's hard to do because it's what we like to describe as a boring and predictable asset class. But one thing that does make me really excited is the market right now. So I've been doing this job for 16 years. I'm one of the founders of Palisade. And I can definitely say that the market right now is the best market for investment that I've seen since we started Palisade. And it really all comes down to supply and demand. And right now, we've got an enormous need for infrastructure, both new infrastructure, and you only need to pick up a paper to see the need for new infrastructure to fund the energy transition or to increase connectivity of our growing population, or to support our onshore manufacturing as people move towards a more just in case rather than just in time approach to supply chains. We're also looking at finding a way to help the government supply homes to the 122,000 Australians who are homeless every night. All this need for new infrastructure is coming at a time when we're seeing two things happen. The economy means that corporate and government balance sheets are much tighter than they have been in previous years, so there's less capital being spent on infrastructure. And we're also seeing some of the more traditional funders of infrastructure outgrow this market. Not only outgrow the mid-market, but outgrow Australia. You look at the large industry super funds, they're all starting to invest overseas. The transactions here just aren't large enough to be material for their portfolio sizes. So all this really means that the supply and demand equation is really heavily tipped in favour of investors and acquirers of assets. And we think this is going to be the case for the next 3 to 5 years. We're seeing more opportunities come across our desk, and we like to partner with people. We like to do deals that we've created, but we're seeing so many opportunities come across our desk at the moment that we don't even need to go anywhere to find good things to do. As I mentioned at the start, one of the challenges of smaller investors investing in infrastructure is just access to opportunities. You'll find that there are a number of products in the market now where managers are starting to focus on wholesale investors, and we're not that different. We actually created a product 4 or 5 years ago for the wholesale market, but we've got a second generation product which is much more tailored to wholesale investors, to providing some liquidity and easier entry and exit. But the beauty of our product is that you're investing directly into our flagship infrastructure portfolio. You're investing directly into a known pool of assets, and these are the assets. This is the diversification of the portfolio. And there'll probably be a few names up there that you recognise, there'll be a number that you don't, but we invest across assets like the Sunshine Coast Airport, you've already seen Granville Harbour, Gold Coast Light Rail, and Quantum is those big white tanks that you see portside that store liquids that are being imported and exported from Australia. Now, I mentioned that in mid-market you can build a nice diversified portfolio, and that pie chart is diversified by sector that we invest in. But when we're looking for investments, we're also looking for diversity of revenue source to ensure that we've got plenty of protection for your investment. Infrastructure is a really broad asset class, and you can invest in high risk and low risk investments, and we try and make sure that we have a good mix so that at least 50% of our portfolio is invested in contracted assets. These are the assets that give you high yield, they give you CPI correlation. And then the remainder of the portfolio is invested in more growth style assets to give you your growth, at the same time as giving you yield, but generally a lower yield. Another example, I've talked to you about a contracted asset, which is Granville Harbour, where all our revenues, all our electricity we generate is bought by the Tasmanian government. Another asset in our portfolio is the Port of Portland. So this is one of Australia's largest regional ports, located in southwest Victoria. It's Victoria's only naturally deep water port. And it's got a great catchment area supporting the Green Triangle region, but it's a long distance between competing ports, giving it its preferred market position. Now, we also like this port because it supports a whole range of different industries, making it very resilient even in times of trade war or economic downturn. You can just see in the photo the various different kinds of commodities that we're exporting. It's a big grain exporter, lots of timber products come through this port. We support the smelter, and if you look carefully, you may just be able to see a wind farm on the horizon. It's not one of ours, but it is one of the users of the port, and we see quite a few wind farm cargoes come in and out of Portland. Now, we first invested in this asset in 2012, and it's a good example of the importance of owning a large part of the asset. We were able in 2018 to take 100% control of the asset, and following that, we managed to restructure the business. We cut out 15% of the costs, but most importantly, we saw a significant increase in engagement from management and staff in the business. We've also managed to introduce another number of other growth initiatives. We've built our own grain export facilities to increase the rate at which we can export grain through the terminal. And most recently, we successfully lobbied the federal government to spend money to improve the rail links to the port. And so once that's complete, we expect to see further growth in the asset. So you can see it's been a really successful business within our portfolio. It's one that we're very proud of. It's the main employer in the region, and it's a big part of the southwest Victorian economy. So finally, just as I mentioned, and I think as Mark mentioned too, we've created a product specifically focused on the wholesale market. It's creatively titled Palisade Feeder Infrastructure Trust. Clearly didn't spend much money on marketing. It invests directly into our flagship infrastructure portfolio. It's got enhanced liquidity to allow investors to come directly into the portfolio and to exit more easily. And importantly, it's been very well rated from both Zenith and Lonsec, receiving recommended ratings that we're really proud of. Thank you very much.